All right, welcome to The Explainer. Today, we're pulling back the curtain on the high-stakes, heavily automated world of investment tax enforcement. Now, we often think of taxes as just this tedious annual chore, right? A stack of paperwork you hand over to an accountant and forget about. But the reality is far more complex and, honestly, a lot more fascinating. What we are actually uncovering today is a multi-trillion-dollar algorithmic matrix. The IRS has fundamentally transformed how it tracks, flags, and penalizes undeclared money. If you hold investments, especially if you've got complex products, crypto, or foreign assets, you are already inside this surveillance machine. So let's get right into it and uncover exactly how this system works and, more importantly, how you can navigate it.
Okay, let's dive into this. $270 billion. Just let that number sink in for a second. That is the staggering amount of federal tax revenue the IRS estimates is lost every single year due to unreported income. And a massive slice of that pie, it comes directly from unreported investment income. We're talking about interest, dividends, capital gains, and foreign source distributions. When you stack this on top of an already massive $428 billion annual tax gap, it means the U.S. tax system is effectively leaving trillions of dollars off the books over a decade. And believe me, the government is highly motivated to claw that money back.
So, because of that massive gap, the enforcement net is tightening, and it's targeting very specific behaviors. If your portfolio triggers what the IRS calls investment income clusters, things like large capital gains, foreign source dividends, or even just checking the wrong passive income boxes, you are significantly elevating your risk. In fact, analysis of IRS enforcement data shows that about 10% of high-income returns with these clusters are flagged for audit or automated adjustments. That's 1 in 10. That rate is way above the average audit rate for your typical wage-only filer. If you have wealth that generates complex income, you are standing directly under a spotlight.
And here's where a seemingly tiny percentage turns into a massive trap. We're talking about the 3.8% net investment income tax, or NIIT. This stealth tax hits millions of middle to upper income U.S. households once their modified adjusted gross income crosses certain thresholds. For example, $250,000 for married couples filing jointly. But here is the crazy part. Surveys of tax prep software users reveal a shocking reality. Less than 20% of taxpayers who qualify for this tax even realize they owe it. That means 80% of liable taxpayers are walking into this trap completely blind. It effectively turns an ordinary, well-meaning portfolio into a stealth tax generator, and most folks don't find out until it's way too late.
Section 1. The Hidden Mechanics. How they catch you.
Let's move to and see how this builds. Because thanks to an $80 billion enforcement boost, the IRS isn't just a bunch of people sifting through shoeboxes of paper receipts anymore. It's evolved into a sophisticated surveillance apparatus. Here is the exact automated trap they use. Step 1. The IRS treats every single 1099 form as a preloaded control variable. Step 2. These variables are automatically cross-matched against your tax return. Step 3. When that match fails, the system doesn't just print a warning letter. The case is auto-flagged and routed into a complex decision tree powered by machine learning classifiers. And finally, step 4. Only after the algorithm has fully built the case does it get handed over to a human expert for review. So actually, scratch that. You aren't fighting an auditor at first. You are fighting an algorithm.
Now here's the part that's frankly kind of infuriating. Financial institutions actually secretly profit from this complexity. Banks and brokers love pushing products like structured notes, private credit funds, or offshore-linked ETFs, often marketing them as tax-advantaged. But these wrappers don't eliminate your reporting duties, they just defer them, making your paperwork incredibly opaque. Because the actual cost basis is so tangled up, it creates hidden friction. You are practically forced into higher-fee advisory arrangements while simultaneously creating the exact unreported income gaps the IRS algorithms are actively hunting. The institutions win on the fees, and you take on the entire audit risk.
And if you hold assets internationally, well, you are dealing with FATCA, the Foreign Account Tax Compliance Act. This is a real game changer. FATCA essentially turns every foreign bank and asset manager globally into an unpaid informant for the IRS. If a non-U.S. institution refuses to report detailed data on your large foreign financial accounts, they face a massive 30% withholding penalty on their own U.S.-sourced payments. Unsurprisingly, they comply, and your data goes straight to the U.S. government.
Because of FATCA, we now have a $10+ trillion global shadow KYC, or Know Your Customer infrastructure. Just think about that scale for a second. Over $10 trillion of global financial architecture entirely dedicated to zeroing in on undeclared foreign investment income. It is incredibly effective. Yet, it's almost never framed that way to retail investors when they go to open an offshore account or buy an international fund.
Section 2. The Trap Springs. Real-world audit disasters.
And this brilliantly illustrates what happens when ordinary high-income earners try to outsmart or simply underestimate this system. Let's look at two totally different scenarios. In one case, a traditional finance failure. A Bay Area tech executive with a $1.2 million Swiss bank portfolio paying about $70,000 in dividends. He figured it was just too small to matter. Well, the FATCA data matched against his return, the algorithm flagged it, and boom, he got hit with a 40 to 50% penalty on the unpaid liability. In the other case, a modern crypto failure. A Midwest investor wired $600,000 into a Bahamas crypto LLC, assuming it was a non-taxable vehicle. Nope. The IRS Crypto Forensics Unit cross-matched his blockchain addresses with FATCA wire data, triggering an intense forensic review. Traditional finance or decentralized crypto, the machine catches both.
To really underscore the damage here, let's look at the final math for that Midwest crypto investor. Over a 3-year holding period, he had an incredible 90% paper gain. He probably thought he was a total genius, right? But after the back taxes, that 3.8% NIIT we talked about, and brutal FBAR penalties, which are massive fines for failing to report foreign bank accounts, his real-world internal rate of return dropped by roughly 17 percentage points. A 90% paper gain was literally decimated down to a mid-20s% after-tax reality. It is a devastating contrast between your perceived gains and the brutal reality of what actually stays in your pocket once the IRS finishes their review. Section 3. The Smart Play. Compliance as Strategy. So how do we actually survive this? We have to completely flip the script. There's this fascinating paradigm shift hidden in the source material, and it goes like this. Declaring investment income is not a compliance chore. It is the first pricing mechanism in the modern tax finance ecosystem. Smart money gets this. They understand that financial products have two layers of hidden costs, the explicit tax and the implicit enforcement premium. That premium rears its ugly head the exact second your tax return fails to align with that massive FATCA data cloud we just explored.
So the crucial point is this. Treating accurate early declaration as a core risk mitigation strategy is absolutely your best defense. It's not just a formality. If you take the time to accurately map your foreign source dividends, capital gains, and complex mutual funds into the exact right boxes on your 1040, you instantly remove yourself from the algorithmic crosshairs. Doing this right from day one is the ultimate way to avoid those crippling FBR and FATCA penalties that can effortlessly wipe out 20 to 30% of your gains.
But look, it's not just about filling out the right boxes. It's about using the right structures. Smart money builds their investments around highly efficient U.S. tax wrappers. We're talking about really utilizing 401k accounts, IRAs, health savings accounts, and modern 1099 tax loss harvesting platforms. When you use these compliant wrappers, you can legally shift that 3.8% NIIT burden downward or completely eliminate it. And the best part? You can do all of this while keeping the exact same economic exposure in the market. You get the same gains without feeding the hidden tax machine.
Which brings us to the ultimate question you have to ask yourself after reviewing all this. Is your portfolio secretly bleeding its ROI to hidden enforcement premiums? And if it is, what is your strategy to stop it? Look, the IRS surveillance matrix is already running the numbers on your wealth. The only question is whether you're going to proactively manage your compliance strategy or just sit back and let the algorithms dictate your after-tax reality. Thanks for joining me for this explainer, and I highly encourage you to go take a close look at your own financial architecture today.